In the high-volatility world of cryptocurrency, mastering technical analysis can give traders a significant edge. Among the various tools used, chart patterns remain one of the most effective for predicting price movement. These patterns are visual representations of market psychology, reflecting trader sentiment, supply and demand, and potential trend reversals or continuations. While no pattern guarantees 100% accuracy, some have stood the test of time across multiple markets, including crypto. This video breaks down the top 10 most reliable chart patterns in crypto trading, highlighting how they work, what they signal, and how to use them effectively to gain an edge. 1. Head and shoulders, an inverse H and S winking face. The head and shoulders pattern is widely respected for its ability to signal trend reversals. It consists of 3 peaks, a central head, flanked by 2 shoulders. In an uptrend, this pattern warns of an impending downtrend as buying pressure weakens. Once the neckline is broken, it's often followed by a sharp decline. The inverse head and shoulders is the bullish counterpart, appearing after a downtrend and signaling a potential rally. These patterns are reliable because they reflect a real psychological shift, bulls losing power or bears being overrun, which often leads to measurable price action. 2. Cup and handle. The cup and handle pattern resembles a teacup, with a U-shaped base, the cup, followed by a short consolidation, the handle. This bullish continuation pattern typically forms during a healthy uptrend. After the handle forms, a breakout above resistance often leads to a strong upward move. It's especially reliable on longer timeframes, daily or weekly, and in assets with strong fundamentals. Traders use volume spikes and RSI confirmation to increase the probability of success. A properly formed cup and handle signals long-term accumulation and a breakout driven by demand. 3. Double top and double bottom. These reversal patterns are among the clearest signals in crypto. A double top occurs at the end of an uptrend, forming 2 peaks at the same level and indicating strong resistance. Once the neckline breaks, it usually leads to a significant drop. The double bottom forms after a downtrend, signaling strong support and a potential bullish reversal. These patterns are highly reliable when confirmed with volume changes, declining on the second top or rising on the breakout from the bottom. They provide clearly defined entries, exits, and stop levels. 4. Ascending triangle. The ascending triangle is a bullish continuation pattern marked by a flat resistance line and a rising support trend line. It suggests that buyers are gradually overpowering sellers. Once price breaks above resistance with a spike in volume, it's usually a sign of a continued uptrend. This pattern is highly reliable in strong markets and is often seen in the early stages of a bull run. Traders typically enter on the breakout or place limit orders just above resistance for confirmation. 5. Descending triangle. The descending triangle is the bearish twin of the ascending triangle. It features a flat support line and a descending resistance trend line, suggesting sellers are increasingly aggressive. A break below support with volume usually leads to a price drop. While it can sometimes break upward, it more often acts as a bearish continuation pattern. This pattern's reliability increases in a downtrend, especially when macro or market sentiment supports the move. 6. Symmetrical triangle. The symmetrical triangle represents indecision in the market, formed by converging support and resistance lines. As price compresses, it builds pressure that eventually leads to a breakout. This pattern can be bullish or bearish, depending on the direction of the breakout. In crypto, symmetrical triangles often form during consolidation phases between major moves. They're especially powerful when aligned with rising volume at the breakout point. Risk management is key, as the pattern is neutral until confirmed. 7. Bull flag and bear flag. Flags are continuation patterns that show brief consolidations before the trend resumes. A bull flag forms after a strong upward movement, flagpole, and is followed by a downward sloping or horizontal consolidation, the flag. Once it breaks to the upside, the trend often continues. Bear flags are the opposite, downtrend followed by a short upward consolidation, usually ending in another leg down. These patterns are highly reliable, especially on shorter timeframes like the 1H or 4H charts, and are favored by day traders and swing traders alike. 8. Penants. Similar to flags, pennants are short-term continuation patterns that occur after a big move. They differ in appearance by forming a small symmetrical triangle, converging trendlines. A bull pennant follows a strong upward move and consolidates with lower volume before breaking out. A bear pennant does the same after a price dump, typically resolving to the downside. Pennants are reliable during periods of high momentum, and when combined with volume confirmation, they become one of the most powerful short-term trading tools. 9. Rounding bottom. The rounding bottom, or saucer bottom, is a long-term reversal pattern signaling a shift from bearish to bullish sentiment. It typically forms over several weeks or months and resembles a U shape. As selling gradually tapers off and buying pressure builds, the asset slowly recovers. Once the neckline is broken, it often leads to a steady rally. This pattern is reliable in bear markets where capitulation has occurred, and smart money is quietly accumulating. Patience is essential, as these take time to develop. 10. Wedges, rising and falling. Wedges are highly reliable patterns, particularly when used to spot reversals. A rising wedge in an uptrend is bearish. It shows that although price is rising, it's doing so with weakening momentum. A breakdown usually leads to a reversal. Falling wedges, on the other hand, are bullish and often appear in downtrends, signaling a potential reversal as sellers lose strength. Volume confirmation is crucial for both, as decreasing volume during wedge formation and a spike at breakout improve reliability. Mastering chart patterns is like learning the language of the market. While no pattern is foolproof, the 10 discussed above are among the most reliable in crypto trading due to their strong historical performance and psychological backing. The key lies not just in recognizing the patterns but in applying confirmation techniques, like volume spikes, RSI divergence, or support, resistance levels, to improve accuracy. Always use proper risk management, set realistic targets, and never rely on a single signal for major decisions. In the volatile world of crypto, consistent success comes from combining pattern recognition with discipline, research, and a well-thought-out strategy.